Hello, everyone. Good afternoon. So a great pleasure to present my paper today. And this is joint work with Anna and Caroline. We know that after COVID, there has been a surge of inflation that makes us worry at an unprecedented level of U.S. government debt, which we know. Oh, hello? Okay. Yeah, okay, speaking to it. All right. So, this rise of inflation made us worry that high inflation depletes the Treasury convenience yield exactly at a time of vulnerable fiscal conditions. Now, we know from the literature that Treasury bonds earn a substantial premium for the convenience yield, and that's a source of fiscal capacity. Now, analyzing the connection between inflation and convenience yield is reviving a central thesis of the 20th century. As mentioned by John Maynard Keynes, as happened in a crisis, liquidity preferences are sharply raised. So different types of assets satisfy the desire of liquidity in different degrees. The recent literature also highlights this as flight to liquidity. So liquidity demand shocks drive the preference for liquid and safe assets like treasuries, increase the convenience yield across the board, but those also serve as negative demand shocks for consumption, and lower aggregate demand leads to lower inflation going forward. On the other hand, Milton Friedman said, inflation raises the cost of holding money and assets that are substitutes to money. To the extent that treasuries are substitutes to money near money assets, this increases the treasury convenience yield, which is exactly opposite to the concern of inflation depleting treasury convenience. So we look at historical data and also quantify a model, and we see that we provide evidence that both channels are present in the historical episodes, but they play out differentially in different periods. So here is one piece of evidence. We're plotting the convenience yield measure. Here is the AAA Treasury spread, as in Chris Mercy, Vissing-Jorgensen, and the following up papers, and the realized inflation, so 1 year change in CPI. So they are both standardized to show the correlations. You can see that there are clearly three distinct periods. Before the Second World War, you can see a clear negative. So during the Great Depression, there's a deflation and convenience yield spike. In the middle period, from 50s to 1990s, you can see that there's a visibly positive correlation, and especially during the 60s and 70s. If you exclude the decade from 71 to 81, the correlation is still positive. That's the period where there's some very difficult to measure the actual long-term convenience yield. And then in the last period after 2000, you can see this correlation turns to become negative again, especially during the financial crisis. Now here I'm showing you the T-bill convenience yield, which measures short end of the convenience yield. So you can see the same broad patterns emerge, right? Three distinct periods. So this consistency in the term structure of convenience yield was thoroughly analyzed in my previous work, where I discovered that this expectation hypothesis on the term structure of convenience yield is really a strong feature in the data. So this indicates long-term treasuries earn similar convenience benefits as short-term treasuries. Now this begets the question, what are the underlying channels of these shifting regimes in history? So we propose that there's a changing dominance of two channels with different underlying economic shocks. The first is what we call liquidity demand channel, consistent with the narrative of John Maynard Keynes. So think about liquidity demand shocks, like, for example, disruptions in the financial sector that make people really want to hold convenience asset, drive up the convenience yield, but they also reduce aggregate demand because they hold more liquid assets and reduce consumption. That lower aggregate demand lowers inflation. So this generates high convenience yield and lower inflation, a negative correlation, which is consistent with pre-Second World War and post-2000. On the other hand, this is the money channel. Think about the cost push shocks that increase inflation. That would increase the opportunity cost of holding money and the near money asset, consistent with Friedman's narrative. And we know that treasuries are substitute to some degree to this near money assets that also increases convenience yield of treasuries. So this tells you higher inflation leads higher convenience yield. That explains the second half of the 20th century. And furthermore, we quantify our model and we find that inflation directly depleting convenience yield is inconsistent with the empirical and quantitative evidence. intuitively, if this channel is really prominently working, then in the middle period, we would see that higher inflation leads lower convenience yield, which is exactly to the opposite to that period. Compared to the literature, I think the contribution here is that we discovered novel regime shifts in the inflation and convenience yield correlation. And we show that it's really a crucial moment for understanding what are the underlying economic shocks in macro models. So let's look at the data. We have monthly data for about a century. Our convenience yield measure includes AAA Treasury spread, as in KVJ, and following up papers, and also a repo T-bill spread, as in Nagel, extended with commercial paper T-bill spread. Now, historically, this AAA Treasury spread has some measurement issues, especially from 71 to 81, which we are going to do a lot of robustness check. But this repo T-bill spread is quite clean and not subject to those issues. And inflation is 12 months change in headline CPI. Now here, let's look at the changing regime regression. So you can see that we regress the long-term convenience yield on inflation and inflation interactive with period dummies. The first row here shows you that in the first period before Second World War, inflation and convenience yield are negatively correlated. Second row, you can see that interactive with the second period, inflation convenience correlation becomes significantly more positive. And finally, in the last period, the correlation gets even more negative or indistinguishable, indicating that both first period and the last period, convenience and inflation move in opposite directions. In column 2 and 3, we control additional factors like Fed fund rate, that contemporaneous Fed fund rate, debt to GDP ratio, and the VIX. If you're concerned about credit risk, we also control for BAA, AAA credit spread. It's not showing up. And we also know that AAA corporate bonds never defaulted. Even accounting for translation into other credit ratings is truly negligible. And then let's look at the table for short-term convenience. You can see that across the board, its coefficient signs are similar, and the economic magnitudes are broadly similar. Now, we know, especially from a recent paper by Lana, Payne, and Shoki, that this convenience yield measure, AAA Treasury spread, had some measurement issues, especially from 71 to 81, because there's a lot of flower bonds which provide a life insurance option. So people holding the Treasury flower bonds can redeem at par if they die to pay estate tax. It was not an issue in other periods, but in the 71 to 81 period, have very high interest rate and interest rate volatility, making the value of the option really high. And on the other hand, there's also call options for Treasuries and AAA bonds. So to address that concern, we provide alternative measures. First, we use the GSW, this one, actually first, let's exclude the decade from 71 to 81, right, where the measurement concerns were present. So you can see that it's still quite positively correlated. And in the middle panel, you can see that we use a different measure. We use the GSW Treasury yield curve, which exclude the flower bonds. And we also do a time series adjustment on the value of the call option. So you can see that correlation becomes smaller, but still quite positive. And finally, we do a prediction exercise. We project this long-term convenience yield on T-bill convenience yield and VIX using data before 1960. And everything out of 1960 is out of sample, and you can see that the correlation is still quite positive. So overall, we conclude that the positive correlation between inflation and convenience yield is a very robust feature in this second half of the 20th century. And to better understand what is the underlying mechanism, here we decompose inflation into supply component and demand components using the measure from Shapiro, which leverages micro-level decomposition. So you can see that for either core inflation or headline inflation, the supply component of inflation is driving this positive correlation that we observe in the second half of the 20th century, while the demand component of inflation is driving the negative correlation, which was prominent post-2000 and pre-Second World War. Another way to look at this is to look at stock bond stock betas, which we know are good indicators for the regimes of supply versus demand components of inflation. So here you can see that conditional on more negative bond stock betas, the inflation and convenience correlation gets more negative. And this negative stock bond beta indicating some demand inflation. When stock bond beta gets more positive, indicating supply inflation, this correlation gets more positive. Okay. Let me summarize empirical evidence. So we discover that there's a significant regime shift of inflation convenience correlation. That correlation was positive in the second half of 20th century, but negative pre-Second World War and post-2000. Dissecting the inflation into supply and demand tells us the supply component inflation is driving the positive inflation convenience correlation, consistent with the money view and the viewpoint of Milton Friedman. And the demand component inflation, like liquid demand shocks, are driving the negative correlation. That explains pre-Second World War and post-2000 period. We also have a lot of robustness checks, and for example, to vary break days, and we also replicate other results using alternative measures of a convenience yield. They all go through. Now, with this empirical findings, let's go through a model to understand what are the economic mechanisms. So we're going to embed two channels of convenience yield into a standard New Keynesian framework. So one is the liquidity demand channel, consistent with the Keynes narrative. So think about liquidity demand shocks, like preference shock for holding liquid and safe treasuries that increase the convenience yield. But those shocks also reduce consumption and leads to lower aggregate consumption and output, and leads to lower inflation. Okay, that tells you higher convenience yield leads lower inflation, a negative correlation, which is consistent with pre-Second World War and post-2000. On the other hand, we introduce a money channel where inflation or cost push shocks increases the opportunity cost of holding money and the near money assets. To the extent that we know treasuries are substitutes to near money assets, that also increases convenience yield on treasury securities. So this channel tells you higher inflation, higher convenience yield, consistent with the second part of the 20th century. So here, households in our model have utility from both consumption and the liquidity bundle, which consists both deposits and treasury securities. These are substitutes as a functional form coming from the literature. And this lambda denotes the relative liquidity demand for treasuries. Okay? So in flight to liquidity episodes, we know that people, they got nervous. They want to hold high quality liquid safe assets supplied by the government. So the lambda would shoot up, increasing the treasury convenience yield. And there are three relevant short-term rates in the model. The first one is the illiquid loan rate. So this is the same as the classic discount rate as implied by the consumption Euler equation. The second and third are the liquid T-bill rate and the liquid deposit rate. They both enjoy they both provide the liquidity and they have this convenience yield. Here we assume that deposit rate is a fraction of the illiquid loan rate following the literature. And this can be microfunded as banks having market power, and so they keep their deposit rate low. If the delta is equal to 0, then the deposits would collapse to cash. So we nest the special case of a cash economy. And then we can log linearize these first order conditions, and we get determination of a one period convenience yield spread. So you can see that it's positively affected by the contemporaneous money policy rate and also affected by liquidity demand shocks. So why it's affected by policy rate, that's again is coming from the substitution. When the policy rate gets higher, the convenience on deposits get higher. That transmits into higher treasury convenience yield because they are substitutes. And then we derive this multi-period convenience spread as expectation of the future short-term convenience yield. And we use the Fisher equation to further decompose that into persistent component inflation and the real rate component. So staring at the equation, you can see that even controlling for contemporaneous money policy rate, the current inflation would have a strong prediction for a long-term convenience yield because we know that current inflation has strong predictive power on the persistent component inflation going forward. And this also tells you, if you look at longer term convenience yield, this inflation component becomes stronger, which is consistent with our empirical results. And then let's set up the remaining standard parts of the New Keynesian model. One is a linearized Euler equation. So this is a standard, except for this liquidity demand term in this blue color. So this is consistent with Keynes' narrative. When there's a liquidity demand shock that increases the relevant discount rate for household, that suppresses consumption and aggregate demand. And this output gap part would also feed into the inflation through a standard Phillips curve. Okay, so liquidity demand shock increases convenience yield that depresses output, that would feed into lower inflation in the model. Okay, consistent with the first period and the third period. On the other hand, there's a cost push shock, an inflationary shock, that directly increases inflation. And through previous slide, the persistent component of inflation would increase the convenience yield. That is the money channel. And finally, money policy rule is an inertial Taylor rule. Okay, so with that, let's solve the model and get some intuitions and estimate the model from the data. So first, let's look at what happens if you inject a liquidity demand shock, which is in this blue line. We injected 100 basis point liquidity demand shock on the short-term convenience. So you can see that this depresses output that also lowers inflation going forward. So this generates a negative co-movement between convenience yield and inflation. Right? So think about this as explaining this pre-Second World War and post-2000 periods. On the other hand, we can also inject a non-liquidity demand shock, like household consumption preferences in the classic New Keynesian model, that actually generate the opposite movement. So you can see that convenience yield went down, but very much smaller movement. So this actually comes from the money channel. So you can see that when there's non-liquidity demand shock, it generates similar macro responses on output gap. So there's a output went down, and then there's accommodative money policy. So money policy went down, and because of the money channel, lower money policy through the substitution with treasuries between treasuries and deposits that lower the convenience yield going forward. Now, this money channel turns out to be truly important for the cost push shocks, which I'm going to illustrate here. So think about the cost push shock that increases inflation. Right? You can see that would lower output. And also there's a policy response. So the short-term rate increases. And through the money channel, when the short-term rate increases, there's substitution between near money asset and treasuries. Treasury convenience yield increases. So that generates a positive correlation between inflation and the convenience yield. This explains the middle period, the second half of the 20th century. Okay? So these are just intuitions. Now let's make our argument rigorous. So what we're going to do, we're going to, first we calibrate standard parameters in the model. And then we're going to estimate shock volatilities in the model period by period so that we know which shock would be dominant in which period. Okay? And we also allow this long-term convenience spread, AAA treasury spread, to be a scaling factor or multiplying scaling factor to map into the long-term spread in the model to allow for mismeasurement in the data. So you can see that this correlation, so here the moments we include are volatilities and correlations among convenience yield, inflation, and output gap. Right? So as we saw, this correlation between convenience yield and inflation is really informative about the presence of liquidity demand shocks. And the model kind of replicates these moments really well, period by period, both the size and the magnitude. Now, let's read what are the implied shocks from the estimation exercise. So in the first row, you can see that this liquidity demand shock is really important in the first period and the last period, consistent with our interpretation. And then this cost push shocks is only present in the middle period. And then we also do an exercise to understand whether inflation directly depletes convenience yield. We allow for inflation directly reduces convenience yield through the parameter B. So the baseline interpret that B equal to 0. Okay? We estimate the model, we find jointly throughout the period with a common parameter B, we find B is close to 0. So the estimation reveals that there's no support for inflation directly depleting convenience yield from historical data. Now you might ask, what about the recent period? Our sample ends in 2020. So what about the recent inflationary period? The story plays out very nicely. So before, around COVID, initially there's a negative demand shock that reduces inflation. So here we use higher frequency measures, which are available in the recent period, inflation swaps, 10-year inflation swaps. inflation swap rate decreases and then recover. And then the high frequency measure convenience yield. Here is the agency Treasury strip spread, which is not subject to any measurement issue. You can see the spike. So that generates a negative correlation. Well, post COVID, you can see that once inflation gets to the normal level, there's additional supply shocks like Ukraine war, supply chain bottlenecks that generate a positive correlation. It's actually consistent with a liquidity demand channel dominant here, and then the cost push inflationary shocks dominant in the later period. And let me summarize. In this paper, we discover a regime shift in history on inflation convenience yield co-movements. We quantify an equilibrium model with liquidity demand channel and a money channel that shed light to the classic thesis on money inflation liquidity, as we know from Keynes and Friedman. And our high-level conclusion is that a century of US data suggests that inflation suggests convenience yield truly matters for inflation and the macroeconomy. Thank you so much.